Not all debt is created equal. There's good debt and there's bad debt. And even when it comes to some of the bad debt, we can transform it into good debt through advanced strategies. And that's what I'm going to touch on here in this video, this episode. And if you're new to the show, my name is Tom Moffat, and we talk all things money here in Canada for those of you who are on their pursuit to financial freedom. So I talk a lot about this on my social media, on my Instagram, but it's really hard for me to dive deep on these topics. So I mentioned this in my last video. I touched on how I'm going to be diving deeper. Well, now this video is more of that broader introductory to the types of strategies that I will be talking about. So when it comes to your mortgage, the standard, the default in Canada is that we are not able to claim the interest on our primary home mortgage. Now, our counterpart, the states, that's the standard for them. They're able to write off the interest on their primary, which is the way she goes. But we do have ways to make our mortgage interest tax deductible here in Canada. It revolves the right structure and a couple extra steps along the way. And to really just give you the three that you're able to do and work with is rental cash jamming, debt swap strategy, and the Smith maneuver. So a lot of you have probably heard the Smith maneuver before. These other two are really a byproduct of the Smith maneuver, but specific to an individual. So I'll start with rental cash jamming. If you own a rental property, then rental cash jamming is likely going to be the best fit for you. And we touched on rental cash jamming in the previous episode. So if you haven't listened to that one, highly recommend go back to it because we go on the topic in more detail. And what I'll do right now is just kind of touch on it briefly. So rental cash jamming allows you to take the rental income, prepay your primary residence mortgage with that rental income, use a line of credit to service your rental property expenses. So we're doing a loop instead of just paying your rental property expenses through the rental income. And the reason why we're doing this is because we're able to write off the interest on the line of credit because we're borrowing with the purpose of generating income. And this falls under the CRA's rules. So that is the purpose, the benefit of rental cash jamming. And the main goal is to convert our debt as fast as possible. Now, when it comes to the Smith maneuver, all we're doing is we're just investing in a non-registered investment and account, and we're just using our line of credit to pay for or to use for those investments. And the interest on the line of credit is tax deductible. I don't teach a lot of the Smith maneuver, and I do think it's an awesome strategy and it's right for a lot of people. But I also don't teach about it because it is more leverage. You're leveraging your line of credit to invest in a non-registered account, which is fine. You just have to really make sure that you're beating the return with your investments versus the interest on your line of credit. The reason why I like these other two strategies, rental cash jamming and the debt swap strategy, is because we're not leveraging anything in addition to what we already have. So the rental cash jamming, again, we're flowing that money. We're not using any additional money. Sure, we're using the line of credit, but we're paying down the mortgage at the same time. And the interest savings from paying down the mortgage far outweighs the additional interest costs on the line of credit, especially because it's interest tax deductible. Now, when it comes to the debt swap strategy, it is virtually the same as the other two. But what's really cool is we're able to make the mortgage interest tax deductible in one shot. So if I were to put these strategies on a tier list, the debt swap would probably be at the top of the list. And the reason why I say that is because, again, we're doing it in one shot. And how it works is, let's just say you have either cash or non-registered investments. What we'll do there is, let's just go with the non-registered investments example for now. You'll sell off the non-registered investments. We'll make a payment on our mortgage, and whether it's at renewal time or whether we stay within our prepayment privileges, that knocks down the mortgage. Then from there, we're going to take it back out from the mortgage and put it back into the non-registered investments. That's why we call it the debt swap. You're just swapping debt. You're not creating extra debt. You're just swapping it. And the reason why we're doing this is because once you take the money out from your mortgage and invest it, that portion of your mortgage now becomes tax deductible. Now, a couple things. You're thinking in your head, well, shit, Tom, if I sell off my investments, I'm going to be paying capital gains. Yes. So very, very important. You want to make sure you run the numbers with your accountant, financial advisor, if you have one, and your mortgage broker that understands the strategy. So when you run your numbers, you want to take that into account. You want to take into account the capital gains that you may or may not have. You want to take into account the fees associated with selling off your investments, if there are any. If you're self-directed, then you likely don't have any fees associated with it. But if you use an FA, it might be locked up in something that you do have to pay a fee. So you just want to make sure you run the numbers and put it in the spreadsheet. If you need to use a spreadsheet dedicated to this strategy, you do need to work with a mortgage broker who understands this strategy. So once you've done that, you've run all the numbers, here's how you would structure the mortgage with the debt swap strategy. So you are making that payment down on the mortgage. Let's just use 50K as an example. You got 50K in your non-registered investments. You sell them off. And let's just say there is no capital gains or fees associated with selling, just to keep this simple, dollar for dollar. You take that 50K, you make an additional payment on your mortgage, pays it down by 50K. Then you take it back out and you put it back into the non-registered investments. 50K for 50K. That's all we're doing. We're swapping it. That 50K is now going to be a separate component on your mortgage. And the way we're doing this is you have to have the right product. So I'll just use Scotia as an example. If you have a Scotia Step mortgage, you're able to have that line of credit attached to it. You make that additional payment, which pays down the mortgage and frees up room on your line of credit. You then pull from your line of credit, put it into the non-registered investments. You can keep it, the 50K balance on your line of credit, or you can convert it to an actual mortgage component. I recommend converting it to a mortgage component because that's going to be sitting there for years. So you want to make sure that you get the lowest rate on that. So in theory, your rate could actually be very similar to what your current mortgage rate is, because again, we're converting it to a mortgage. You're gonna have two separate components there. Okay, so that's the structure of the mortgage. You want to make sure that you have high prepayment privileges before you do this to make sure that you're within it. And you want to make sure that you have a readvancing line of credit. And if you don't have any of this, you can either wait. Renewal time is a really good time to do this, or when you're buying and selling, also a really great time to do this. So that's the debt swap strategy in a nutshell. And the benefits of doing this is you're going to be able to write off the interest on that component. Some people, they're able to do this in one shot with their whole mortgage. Like we did one with a client that had 400K left on their mortgage, and we did it in one shot. And that was really, really cool because we did that at renewal time. So imagine just making your mortgage completely tax deductible in one go. And that's why the debt swap strategy is really, really awesome. And every year you're going to be writing off that interest. You can take if you're employed, you're going to take the tax returns, pay down your mortgage even quicker, and or you can use it for investing, vacation, pleasure, whatever you want to do there. So I'll leave it at that for the advanced strategies. Now, I just want to talk briefly about consumer debt. If you have consumer debt, whether it's credit card, line of credit, like unsecured line of credit, or you have like a really high interest car loan, I would highly recommend focus on those things first. Pay down your debt first before trying to implement these advanced mortgage strategies. These strategies are there for people that have their debt paid down first, and that's not their main priority at that point. Because in my opinion, if you're drowning in debt or you're behind on payments, this should be an afterthought, these strategies. And we often have people that do book calls with us on social media, and they're in these situations. And it's honestly a byproduct of how the economy, how things are right now from a expense perspective. Like everything is more expensive these days. It's the honest truth. So a lot of these people are in that situation. And if that's you, that's okay. There's nothing wrong with that. You're not alone. We talk to a lot of people on a daily, weekly basis about this. So first thing I would recommend doing is if you have that consumer debt, let's get rid of that bad debt. Those are consumer debt is bad debt. Your mortgage is bad debt if it's non-tax deductible, but it's at least better debt than your consumer debt. So one option you could do is you can bundle in that consumer debt into your primary home mortgage by either doing a debt consolidation. So you're just refinancing your property and you're bringing it in there, or you can add a line of credit to your mortgage and do it that way, and then convert it to a mortgage component. There's different ways about doing it. So if that is you and you are looking to free yourself from a monthly perspective, you're tight on cash, then please reach out. Our team is really good at doing this, and we can set you up with a mortgage, bundle it all in there, lower that payment at the same time by stretching out your amortization, give you some breathing room until you can get back on your feet.